If you've been following the news, you've probably heard a dozen, maybe more, conflicting stories about the US economy. Is it strong? Is it fragile? Honestly, it's pretty confusing. So today, we're going to cut through all that noise. We're going to look at the hard data and see what's really going on with the American consumer. Ready? Let's dive in.
And this quote right here from Wolf Richter, it just nails the central puzzle, doesn't it? Consumers may be in a foul mood, but they're making money and are spending it, and are still saving some. So on one hand, everyone feels, well, kind of crummy about the economy. But on the other hand, the numbers seem to be telling a totally different story. That's the great disconnect we're going to unpack today.
So yeah, what is the real story behind all these headlines? Are people actually out there spending money? And maybe more importantly, can they actually afford it? We're about to find out by digging into the data. But before we jump in, there's one really important idea we've got to get straight first.
Okay, so throughout this whole thing, you're going to hear me say inflation adjusted or real value a lot. This is absolutely key. All it means is that we're looking at the numbers after we account for inflation. We're not just looking at the sticker price, you know? This lets us see the true picture of whether things are actually growing or not. Make sense? Cool. With that out of the way, let's get to our first section. All right, let's tackle this great disconnect head on. You've got the feelings on one side, all the doom and gloom in the headlines, and the figures on the other. So what does the actual data say about our spending habits? Well, the answer might surprise you. Get this. Despite that sour mood everyone's talking about, inflation-adjusted consumer spending is actually up 2.6% from a year ago. Now, what's so interesting here is that a 2.6% increase in real spending, that's actually solid, healthy growth. In fact, it's pretty much right in line with what we used to call the good times before 2020. So yeah, people are, in fact, spending more than they were a year ago, even after you factor in inflation. Okay, so we've established that spending is up. The next logical question is, where is all that money going? Let's break it down into the major categories and see what's really driving this trend. So, take a look at this. It's pretty clear where the lion's share of our money goes. A full 2/3, 66%, is spent on services. Now, that's everything from your rent and healthcare to your Netflix subscription and your phone bill. The rest is split between non-durable goods, think groceries and gas, and durable goods, which are the big ticket items like cars or couches. I mean, it's obvious. Services are the real giant here. And here's how that spending growth breaks down. If you look at the two biggest categories, they're looking really healthy. Spending on services is up 2.6%, and on non-durable goods, it's up at pretty strong 3.3%. But then you see that 1.1% for durable goods, and you might think, that looks a little weak. But there's a really, really important piece of context that you need to know about that number. And here's the crucial point. We are comparing today's spending to a period last year when there was this massive spike in people buying durable goods. I mean, everyone was buying cars, appliances, furniture, you name it. So the fact that spending grew at all from that incredible peak is actually a sign of serious resilience. It's not a collapse, not by a long shot. It's just things kind of getting back to normal after a pretty wild period. So, all of this brings us to the most important question of all, right? How are people affording this? Is this all just going on credit cards? Is this a house of cards? Well, to answer that, let's flip over to the other side of the ledger and look at where the money is actually coming from. So when we talk about personal income, it broadly comes from two main places. First, you've got the money we earn from our jobs and investments, so wages, salaries, dividends, that sort of thing. And second, you have what are called government transfers. Think Social Security, unemployment benefits, and stuff like that. And here it is, the headline number for income. After you adjust for inflation, the money people are earning from work and investments is up 1.5%. Now, this is a huge deal. Why? Because it means that on average, our paychecks are finally beating inflation again. That's a really positive sign. But at the same time, we can't ignore the role of government transfers. They actually make up a pretty significant chunk of total personal income, 19% to be exact. A big part of this is the growing number of boomers who are now receiving Social Security, and that provides a really stable income floor for a huge portion of the population. Okay, so let's recap. Spending is up, and it looks like it's being funded by income that's actually beating inflation. That brings us to the final piece of our puzzle, what's left over. Let's take a look at the savings situation. First, a quick definition so we're all on the same page. The personal savings rate is simply the percentage of your after-tax income that you don't spend.
And it's important to remember, this doesn't mean it's all just sitting in a savings account. It could be used to pay down debt or to buy stocks. It's just the money that isn't being spent on consumption.
Right now, the savings rate is sitting at 3.5%. The single most important thing about this number is that it's positive. It's not negative. That confirms that all the spending growth we're seeing is being funded by real income, not just by people racking up more and more debt. There's even a little bit left over. Now, to put that 3.5% in context, yes, it's lower than the unusually high rates we saw during the pandemic when nobody could go out and spend money. But, and this is a big but, it's actually higher than the rates we saw in the years right before the 2008 financial crisis. So, while savings aren't exactly sky high, we're not in the kind of danger zone that came before the last big downturn.
Okay, so we've looked at spending, we've looked at income, and now savings. Let's step back for a second, put all the pieces together, and figure out the big picture takeaway from all these numbers.
You know, when you put it all together, the data tells a remarkably consistent and, frankly, pretty positive story. 1, consumer spending adjusted for inflation is solid. 2, this spending is being supported by incomes that are actually growing faster than inflation. And 3, a positive savings rate shows us that this is all being funded by real earnings, not just a mountain of new debt. The whole thing holds together.
And that brings us right back to where we started. The data. It paints a picture of a surprisingly resilient and functioning consumer economy. So this leaves us with one fascinating final question to think about. If the numbers are this solid, why does everything feel so fragile? Why is the public mood so sour? What is causing this deep, deep disconnect between the economic data we're seeing and how we experience it in our daily lives? Well, that's a topic for another day. Thanks for joining me.